Right, okay. How are we doing, guys? Okay, so thank you very much. What a pleasure that was for me personally, and I hope you found the conversation interesting to be chatting to both the Governor of the Central Bank of Jordan and the CEO of Arab Bank Group. Right, we're going to take... gosh. I'm ahead of myself. And you of all people, how can I do that to you? Right, I'm going to step off for a second, okay, because you're thinking, we've had enough of this Morad bloke. I'm going to step off for a second, and I'm going to introduce our first panel discussion, okay? Our first panel discussion, and that is going to be, well, it's on the subject of inflation. We've heard many of our speakers already talk about the inflation battle, monetary policy. We're going to have a panel discussion on inflation. Is the inflation battle won? The topic is high interest rates. Is the inflation battle over? Lessons learned and 2025 forecasts. Okay. Now, I'm not moderating that one. Phew. It's been moderated by Ms. Yasmine Saleh, who is with the London Stock Exchange Group. Now, Yasmine has so much energy live that if you connected her to the electricity grid in Egypt, you could probably run Cairo for a week.
I'm here. I can hear you, so be very careful. Good morning, everyone. Hello, Aqaba.
Wait a minute. I've not finished my introduction yet.
I want to show, not tell.
If you connected it to the electricity grid, you could probably run Cairo for a week. So, right, Yasmine, a pleasure to see you.
Pleasure is all mine, sir. Thank you, Mo. And Mo, if you like mangoes, you need to go to Egypt, man. And for $5, you can get a box. We have the best mangoes ever. Who here is from Egypt? I want to see a show. Yes, don't we have the best mangoes ever? Good morning, everyone. What a show. I thought I'm going to be in front of 10 people. Oh, my God. We really rock, right? Like, we came no matter what. Everyone who canceled, like, sent long emails, missing it, wishing they were there. Stephen actually had always been virtual because he had a commitment, but he was non-stop texting, checking. This is how we do it in the Middle East. Good morning, everyone. We're going to wait for Stephen to join us anytime. But first, Randa. Wow, I love female bosses in finance. That was really cool. I have a tough question for you. Do you think we can live to see a central bank governor who's a female? Like in the coming 5 years, I mean, we're going to live longer, but maybe in, I mean, I don't know the war, but inshallah, we do survive. But in the coming 5 years, not in Egypt, no, I would say no. Jordan, I'm going to come down to you. Jordan, I hope, and we have the central bank governor here as well. Will you support, sir? Just like the presidential election in the US.
Of course we support. Of course. But do you think Randa would agree to be a governor?
Is it that hard?
It's not like hard. It's of course it's hard, but yes. By the way, the Central Bank of Jordan is in favor of empowering women, of course. We have just issued regulations that by starting 2026, we should have 20% of member boards female. And this is the first time we have done it.
Randa, what do we need to do to see a female governor in the coming 5 years? It's not gonna happen.
I don't think it's about the time, you know, it's not a time element. I think we have enough females coming through the pipeline and they have the capabilities. But I think, as Dr. Adel is saying, it depends also, you know, what women want to be. If they just want to be CEOs. Exactly. And frankly, they have an extremely tough job, to be honest. So Dr. Adel is saying, you know, he has a very, very tough job. So it just depends. I think it's about just women leadership. Wherever we are, I think that is, we have to be the mentor, the figures that people can do it. I think that's the most important thing, rather than just a position and where they are and time element. No, on the contrary. No, not the contrary. Because I just had male bosses.
but you're going to...
No, that's all. And on the contrary, I think females right now, and we didn't have a chance with Dr. Murad to go through it, like we have a whole empowerment strategy framework that we're doing, and it's part of our ESG. And it's about empowering women, not only in the workplace, but also in the supply chain, in the marketplace, everywhere.
Okay.
All right.
Great.
So thank you.
Thank you so much. Stephen, you're here. Hello. Guys, let's give a big round of applause to our one and only Mr. Stephen King from HSBC. Our expert on inflation, of course. Stephen, can you see the attendees? These are people coming from all over the world to Jordan Aqaba, while Iran and Israel are fighting above, very nearby. We actually saw the missiles the other day. Who saw them, guys? Yeah? Team LSEG, yeah, we did, yeah. Fireworks for us in that region, you know, we're so used to it. Stephen, good morning.
Good morning.
How are you?
Well, it's lovely to be here virtually. I'm not quite here physically, but I am here in spirit, so I'm very happy to be with all of you today.
Lovely seeing you, sir, as usual. Stephen, we have you. We want the overview of the inflation for the year. How do you see it so far? With a focus on China and the US, of course, we all know the numbers. The US, the latest figure is 2.5% in August, which is a little bit better than the 2.9 scored in July, and it is the smallest year-on-year rise since February 2021. China is 0.6 versus 0.5 in July, better than expectations, which stood at 0.7. My God, I speak non-stop, I want to breathe. Okay, and it is the fastest pace in half a year. So this is where we stand. How do you expect the year will end?
It's worth stressing, first of all, that the experience of China and the experience of the US over the last 2 or 3 years have been completely different. The US has been battling against inflation that has been, frankly, far too high. And China has been battling against an inflation rate that's been far too low. And if you want an explanation for why these inflationary experiences have been so different, it probably stems from the fact that in the early stages of COVID, the Federal Reserve provided massive monetary stimulus, whereas the Chinese were much more cautious, partly because, of course, COVID was not such a damaging experience initially for China. The lockdowns were far more modest in China. And as a consequence, the economic hit in China was also much smaller. The Federal Reserve also believed that the hit was mostly a demand-side hit rather than a supply-side hit, and therefore felt that it was important that there should be maximum monetary stimulus. And it was really in 2021, particularly later that year, that the Federal Reserve began to realize that this stimulus was too much, that they'd left interest rates too low for too long. They'd focused initially on the idea that any inflationary shock was transitory. It turned out that it wasn't transitory. And of course, at that point, the Federal Reserve had to provide huge amounts of extra stimulus, extra restraint, should I say, which the Chinese, of course, didn't really need to do. So what I would suggest, therefore, is that for all the talk about inflation being caused by the impact of COVID, the impact of Russia's invasion of Ukraine and the consequences for global energy and food prices, the underlying difference between the US and China actually owe quite a lot more to the different ways in which policy itself came through, particularly in 2020, as I say, with that massive Federal Reserve monetary stimulus. Now, as far as this year and beyond are concerned, I think one way to characterize this is to suggest that the US certainly is heading in absolutely the right direction. Inflation is heading back towards target. China is still really suffering from inflation being too low, so it's more kind of disinflationary, deflationary story in China. But as far as the US is concerned, the big focus from now on from the Federal Reserve is probably not going to be inflation, frankly. It's going to be unemployment. And the reason for saying that is partly because Jay Powell has already said that the labor market is the key factor now for the Federal Reserve to focus on.
That's true.
But also because the unemployment rate in the past, the unemployment rate in the past has been an excellent sort of cyclical lead indicator or coincident indicator. And the rise that we've seen in unemployment in the US over the last 12 months has only been seen in the past prior to recession. So what the Federal Reserve is now basically saying is we've got inflation under control, but the cost of getting inflation under control has been a savage tightening of monetary policy, which now might have real economic consequences. So basically signaling we need to get interest rates down fast to try to avoid the recession that itself might be a consequence of the earlier monetary tightening.
So following up on that, I'm going to move to a question that I had like as number 3. Do you think they are going to do another half-point cut in November? Do you think that this is, because I mean, I think traders are betting that we're going to reach, you know, like the 3 to 3.25% rate by next year. So do you think that, do you see it happening now?
Well, let's just see what the data delivers over the course of the next few weeks. I mean, the tricky thing here for the Federal Reserve is that if it starts cutting by 0.5% each meeting, then I think people will begin to wonder whether the Fed has seen something that the market hasn't yet seen, that's beginning to really worry about the possibility of recession, has concluded that interest rates are far too high and they have to fall very, very quickly. Now, the problem for any central bank in those circumstances is that they don't want to be accused of effectively creating fearful conditions that themselves actually contribute to a recession that subsequently follows. But having said that, I think it's perfectly reasonable to think that over the course of the next few months, we're going to see a lot of rate cuts from the Federal Reserve. I mean, bear in mind that Fed funds, the target rate was at a peak of 5.25 to 5.5. I reckon that by the middle of this coming year, we'll be down to between 3.25 and 3.5, so a good 200 basis points off from where we were at the peak. And if there are further signs of the labour market deteriorating, if we were to see a further sustained increase in unemployment from where we are currently, then in those circumstances, maybe even more rate cuts to come. So, as I say, I think the attitude of the Federal Reserve has shifted rapidly from worrying about inflation to worrying about recession. However, it is worth stressing that the inflation rate is still sticky compared with what we had seen prior to COVID. The period from the global financial crisis through to COVID was one whereby inflation tended to be too low rather than too high. And even with the progress that we've seen, it is still fair to say that core inflation, excluding food and energy, and this is the CPI measure rather than the Consumers Expenditure Deflator measure, which is the one that the Federal Reserve prefers to use, but looking at the core CPI number at the moment, excluding food and energy, it's still running at above 3% and has been so for the last 3 months. So I would suggest that for the Federal Reserve, it's an awkward tightrope to walk. Yes, there is a recession risk, but there's still a degree of inflation stickiness that hadn't been there for many, many years. This is an interesting new challenge for the Federal Reserve relative to where we've been in the past.
Okay. Actually, also interestingly, interest rate future contracts reflect a 54% chance of a half-point cut in November versus a 46% chance of a quarter-point cut. Let's take a bet. Who here thinks we're going to get another half-point cut November? Seriously? Okay, 2. Okay, quarter? Okay, interesting. Stephen, do you have anything to say to that?
Well, I got the impression, I couldn't see very clearly, but I got
quarter
the
is
impression
more expectations for the quarter. More
Yeah.
expectations for the quarter point cut than the half point cut in November.
Yes. Well, I don't have anything strong to say there. Maybe your audience is far better informed than the market at the moment, which wouldn't surprise me.
Okay. Moving to China, guys, do you know which group went really up in August, like a group within the inflation group, like food, fuel? Does anyone know? Food. Do you know why? Food went up by 2.8%. Finally, climate change, right? They suffer from floods, heat waves, and that affected the food prices. And we also have, if you can go to China, if you guys see, we have the PPI deflating, worsening, actually, deflation worsening. Steve, what do you think about that? I mean, yeah, we do have low inflation, but we have a surge in food prices in China. And I'm sure you're following the PPI indicator as well. What do you think?
Well, as I said before, China has a big sort of disinflation, deflation problem. Yes, we can focus on food prices from month to month. We can think about the impact of climate change on various supply chains over a period of time. But the underlying story in China, as I say, is fundamentally different from the story that we've witnessed in the US and, for that matter, in most of Western Europe. Now, I think that in considering China's difficulty, you have to go back to the underlying economic performance decade by decade. So if I can just remind you, before the global financial crisis, so this is before 2008, the Chinese economy was happily growing at around about 9 or 10% a year in real terms, and basically driven mostly by exports. It was an incredibly powerful story where China's share of world trade was continuously rising. Then you move to a period between the global financial crisis and COVID, where the export story fades rapidly, but yet the economy is still growing at between 6 and 8% in real terms. And that growth rate is partly a function of huge property investment. So basically, the source of growth shifts from exports towards property investment, commercial property, residential real estate, and so on. And then post-COVID, the economy's growth rate has dropped to between 4 and 5%. So it's a lot slower than it was. Now, admittedly, the economy is much bigger than it was. So it's still making a major contribution to global growth, but nevertheless, momentum has faded quite a long way.
But they want 5%, like that. This is what they want to achieve by end of year for growth rate.
Yeah, they want 5%, but of course 5% is still lower than the numbers that they had routinely been achieving pre-COVID and certainly pre the global financial crisis. So the target may be 5, but the tricky thing here is that they now have a serious headwind that's partly associated with a property bubble that's kind of burst. It's gone into reverse. And it's a classic sort of balance sheet problem whereby the more that property prices fall, the weaker is the economy. The weaker is the economy, the more property prices fall. The more that they fall, the greater are the bad debts within the economy. That creates balance sheet constraints that weren't there previously. The less willing are people to buy properties because they expect prices to fall further in the future rather than go up in the future. And so, there's been a lot of discussions in Beijing and elsewhere about the experience of other countries that have had, property-led constraints. Now, one example of this, of course, is the US during the global financial crisis with the bursting of the subprime bubble. Another experience, which I know Beijing's been particularly interested in recent months, is the Spanish experience around about the time of the global financial crisis and thereafter. So I think in trying to deal with this underlying problem of low growth and low inflation, it's not just a case of what the PBOC does in terms of rate cuts or reserve requirements or whatever. It is also a structural issue about what you do about the property sector. And it wouldn't surprise me if at some point you have the creation of a sort of bad bank arrangement where you try to take off these non-performing assets from the banks themselves, allowing them to lend more freely and for trust to actually increase between the banks relative to what might have been the case in recent times. There's also lessons here from Japan, of course, in the 1990s and beyond. So I think for China, the property sector has to be dealt with to a certain degree. At the same time, on a more positive note, of course, China is trying to go up the sort of technology frontier rapidly, and it has been doing so, which might imply that there are productivity gains to be had over the course of the years ahead. And it's also worth stressing that, and I think this is something that's worth noting, is that China isn't really one economy. We think of it as being one economy because we always think about one country being one economy. But China actually is divided into two completely separate economies. There's a sort of coastal, eastern, wealthy, productive economy, and then there's an inland, in fact, not just rather, much poorer economy that's not being connected as well to the rest of the world. And if you're thinking about long-term growth in China, it has to really connect with that inland economy, making it more productive, more dynamic than it has been in recent years. If China can pull off that trick, then in those circumstances, there's a good opportunity for continued decent growth in the years ahead. But as I say, I think in terms of the inflation and growth story at the moment, it's not just what the PBOC does, it's also this problem in terms of the property sector and the way it creates a kind of headwind for future growth and deflation.
Yeah, interesting. Egypt is very similar. Also, we need to work on the inland economy, but of course, different size compared to China. I mean, we're nothing. So, the geopolitical situation. I'm not going to call it geopolitical situation. The war that we have in the region, sadly, but that's the right word to say, to be honest, or to explain it. Do you think it will impact the West? I mean, we know what will happen here, or at least we'll see it, but it will be within our expectations. And also, the region is used to it, sadly, but that's the truth. So, do you think it will impact the West in any way with regards to inflation, monetary policy?
So if you go back over many, many years, and I'm old enough to be able to do so nowadays, I can tell you that, I mean, I think for most economists, you look back at the 1970s and you think, oh yes, two big oil price shocks. If we have something similar, that will be extremely damaging. But there are, I think, a couple of things that are worth stressing, which are different from the 1970s. The first is that, of course, the 1973 oil shock was partly an OPEC oil embargo on the West, which led to a quadrupling of oil prices. Now, I'm aware that oil prices have risen, $10 a barrel or so over the last day or so, but we're only at sort of, $77 a barrel or something like that at this stage.
I don't think the Saudis are going to do this time. I don't think.
No, absolutely. I was going to say, I think the chances of an embargo of the kind that we saw in 73 are extremely low. And then in terms of 78, 79, it was mostly associated with the Iranian Revolution, and oil prices then doubled. So you had a quadrupling in 73, a doubling in 79. And of course, in both cases, that meant huge consequences for Western oil importing nations. This time around, unless you saw something on that scale, I don't think anyone is as yet predicting that kind of scale. It is very unlikely you're going to have the same kinds of impacts either on inflation or on economic growth. However, the thing I just mentioned is that it's also worth stressing that the 73 oil price quadrupling probably was sustained only because prior to the embargo, inflationary conditions were already wildly out of control in the Western world. So looking at, for example, the US, inflation was accelerating pretty rapidly in the late 1960s, continued to accelerate rapidly in the early 1970s. The international monetary system collapsed in 1971 with the collapse of the Bretton Woods exchange rate system. And so therefore, there was no clear anchor for inflationary expectations. So the idea that we're going to go through an experience on that kind of scale, I think, is pretty remote. Also worth stressing that more recently, it turns out that the opportunity for diversification in terms of energy is perhaps greater than it once was, partly because of alternative energy sources, partly because the control of energy is not quite so monopolistic as it was.
Sorry, Stephen, the alternative sources, they don't really contribute much. We still rely on fuel. I mean, look, when, what happened in Russia and Ukraine, everyone, surged the productions, everyone begged Saudi to increase the production. So I think it's still, because we just had a Green Summit session in Egypt, and we had the CEO of the carbon market in Tadawul, and she's yet to launch the market. We're at a very early stage, especially in that part of the world, and I'm sure everywhere. So I don't know. Do you think alternatives can play a role?
What I was going to say was first of all, maybe I'm speaking particularly from the UK perspective, because the UK is certainly much greener than it was, and we are much more dependent on renewables than we had been, say, 10, 20 years ago. But the second thing I've noticed is that you're absolutely right. Obviously, with Russia, Ukraine, gas prices in particular went up dramatically across Europe, including the UK, and it was a very substantial shock. However, it was a relatively short-lived shock. It wasn't like the shocks of 73 and 79, because in this particular case, gas prices went up and actually came down very, very quickly as alternative sources were found relatively quickly. Whereas, of course, in 73 and 79, oil prices quadrupled and then doubled and stayed at those new higher levels for year after year after year. So the gas shock was nasty for a year or so, but it unwound extremely quickly. One reason, of course, why inflation rates have dropped so quickly over the last 12 months or so. But compared with 73 and 79, very different story. So all I'm saying really is that notwithstanding the fact that we're still very dependent on carbon, I fully accept that.
Yes.
The flexibility of supply is better than it was, The sense of a monopolistic controller who will keep prices higher for longer is lower than it was. And as I think you quite rightly have pointed out, Saudi Arabia is not in the business of trying to damage Western interests at this stage.
The Gulf, UAE as well, yeah. So it's different times, definitely. I'm going to move quickly to the region, Stephen. I know this is not your area of expertise, but if you want to give us, any general feedback or anything, because I know that people would be interested to hear from you anything on the region, which is an emerging, which is full of emerging countries and economies. I'll focus on Egypt and Saudi, but let's start with Saudi. The inflation is within the one-digit range, inched up to 1.6 in August from 1.5%. Interesting in Saudi that it's driven by the housing rentals, which soared by 10.7% in August, which, yeah, that means rents have gone up, but also people have benefited. If you are an investor, you get more money, which happens in the UAE where I live all the time. Man, I'm not gonna go into my rent and the increases and how much money I'm paying, but the landlord is making a lot of money, so at least someone is winning. Egypt, on the other hand, Abul Faris, can we go to Egypt? Thank you. Egypt, on the other hand, it's double digit, it's 26.2 in August, and it increased from 25.7 in July after relatively a short period of declines that didn't last long. Why? Fuel and food. So in Egypt, the situation is different. Nobody wins, when food and fuel prices go up. In Saudi, you have people winning from the rental market. Do you think that Egypt can do something on its rental market? It built all these amazing communities that people are so upset with because they felt, the IMF money was spent on them. But can maybe they do something, change the laws, like the rents, because the rents there, Stephen, is pathetic. The least I can say. Something like, I don't know, like $200 a month, and this is in a fancy place. So can they do something about that? The figure will still be high, but at least it will be driven by something else, or added to the food and fuel to be practical. It would be, we can add the rental market. What do you think? Doable?
Well, first of all, I have to tell your audience, I'm no expert on either Saudi or Egypt, so I'm going to only make some very, very general comments.
Fair enough.
First, most obvious comment really is that Saudi and Egypt are fundamentally different economies. One is
of course.
major oil producer, the major oil producer, and also has a very healthy balance of payments position. And importantly, associated with that healthy balance of payments position, it has vast sovereign wealth funds. So it is in a very, very good position to cope with future challenges and future changes. So, Saudi's challenge really is to say, well, 10, 20, 50 years time, if demand for carbon is lower, associated with some kind of green transition, if it's lower, how do you transform the economy? And it's pretty clear that Saudi already has very, very powerful ideas as to how that transformation may happen. In terms of diversifying into a whole range of different industries. And frankly, if you are a commodity producer faced with the possibility that your commodity will not be quite so attractive in 50 or 100 years' time, that's the sort of thing you probably want to do. Yeah. If I can give you a historic example, in fact, the headlines came through just last year, or then it was last week, shall I say, that Britain had produced its last ever coal. Now, Britain was built on coal in the sense that in the 19th century, in the Industrial Revolution, coal was a fundamental feature, the fundamental feature really of the British economy, and it allowed for the Industrial Revolution to happen. We don't produce any coal at all anymore. And it's because the British economy has diversified significantly over the last 100, 150 years. And the same thing is the sort of thing that Saudi probably needs to do. As for Egypt, well, first of all, it's not an oil producer. Secondly, it has a
it's an importer of everything. Be frank, and you know that I'm Egyptian, but I know the truth. We import everything we produce.
No. Well, I was going to say that the problem that Egypt has, in one sense, is that it has a very, very weak balance of payments position. It's a classic emerging market, which is dependent really on the kindness of strangers, if I can put it that way. In other words, it has a large current account deficit. It has to fund that current account deficit one way or the other. And when economic conditions elsewhere in the world change to reduce that funding, then of course at that point, Egypt ends up in significant difficulty. So over the last few years, as US interest rates were rising, emerging markets in general finding it more difficult to fund their balance payments positions. Egypt in particular, very vulnerable in those circumstances. Higher interest rates, higher imported food prices, a pretty messy situation. And the way often that you, as an emerging market, you end up dealing with this, often in a sort of unintentional fashion, is that you let your exchange rate fall because you can't fund the balance of payments position. In the process of the exchange rate falling, you suddenly discover you've got more inflation than you wanted, which is exactly what's happened in Egypt over the course of the last few years. And digging yourself out of that hole becomes increasingly difficult. Now, what you ideally want in these circumstances is, if you like, an adjustment in the real exchange rate, which is a sort of economist's euphemism for real wage cuts, which no one really enjoys, of course. But you're trying to make yourself more competitive than was the case previously, and trying to reduce your dependency on imports. But to get to that stage, typically requires some considerable level of austerity, which politically is always very, very unpopular. So Egypt can hope for much lower rates from the US and elsewhere, which may help in terms of funding higher capital inflows. It can do something with what it does with those inflows in terms of what they're invested in, trying to improve productivity, higher returns on capital, and so on. But in terms of a comparison with Saudi Arabia, very different kind of story, obviously.
Yeah, all of that, and you're not an expert on the region. Had you been an expert, what would you have said? You have it all, Stephen. It's really a pleasure having you. One last question. If you are to give a headline for 2025, what would it be? And just let me give you a hint. I want something really bold, like something that suits my hair, you know? Are we looking at, like, right? Mo? Why are you laughing so much, man? You don't have any of it. Okay. Do you think we have a BRICS block inflation index, something like that? Do you think like we're going to have, especially with what's going on in the region, more countries joining a new economic bloc? What do you think will happen, you know, like next year, anytime next year?
Well, I think there are two big things to watch out for. The first one, which is partly a sort of political observation about the US, is what is the relationship between the US and China? How does that evolve? Does it get worse or better over the course of the next 12 months? And part of that will depend on what the US approach is after the presidential election, with the possibility of tariffs being imposed on China, because basically Trump has threatened to do that. Tariffs he's threatening are pretty big. So we could be involved in some kind of trade war. The second thing I would note, I think, in terms of positive themes, which certainly relates to your region, is stronger connections, growing connections between the region, particularly the Gulf, and India. I think that could be a very powerful story in the years ahead. And in terms of things that worry me, I suppose the bottom line here is that, like the Federal Reserve, I'm concerned that the degree of monetary tightening that we saw in the US, which was designed to bring inflation under control, may come with bigger domestic economic costs than have so far been recognized. And if history's any guide, next year could be a pretty bumpy domestic year for the US.
Stephen King, thank you so much for being here. And if you ever run for office, I want to get the first interview. You have to promise me that. Thank you, ladies and gentlemen. Thank you. Mo,
thank you
floor
very
is
much.
all yours.
No, thank you. Can you hear me? Yeah. Thanks very much, Yasmine. That was fabulous. Mr. King, a pleasure as always, even if it was virtual.
Thank you very much.
Yasmine, that was fabulous. Thank you so much. Yes, great. Thank you. See you soon. Right. Okay, guys. Right, I'm mobile now. We don't need any of this. It's our break. Before you go, right? Wasn't I right? If we could just bottle some of that energy, we would have a solution to the energy crisis right there. Now, we've got a break. Please be, well, naturally, yes. Naturally, it's royalties for you. Please be, so half an hour, I'll make it 11, just approaching 11 o'clock local time. So half an hour, please be promptly back because we have a last-minute change to the program. We have a straight presentation from John Ho, who is based in Standard Chartered in Singapore. He's going to be talking about digital currencies, central bank digital, crypto, that whole digital space. Okay, that word encompasses so much. So please come back here promptly for a straight presentation from John Ho on digital currency, central bank digital currencies, crypto assets, and all the like. See you shortly. Thank you very much. Thank you.